Marcus Rosgan, Asia Pacific Equity Strategist with Citi, joins us live from Hong Kong. Marcus, good morning and thank you for joining us. Looks like globally we are in for some degree of calm and quiet trading session. For the moment, tapering fears have taken a backseat, but there are no fresh triggers.
Hi, good morning. Well, in terms of fresh triggers, the way we would look at it is there are certainly things out there that are good for markets. Number one, we think the global growth environment is improving. You've got U.S. acceleration into next year. You've got a European growth recovery. So certainly from that perspective, that's a good thing. Secondly, overall valuations, even for the Indian market, are below their historic averages. And so again, cheap markets tend to go up, expensive markets tend to go down. So from that perspective, again, things are generally positive. If you look at a third one, in terms of earnings growth, there is still earnings growth out there. So again, generally that should be a positive for equity markets. And so today's tone in the market, I don't think necessarily sets the tone for the remaining 12 months into next year.
Marcus, hi, morning. What's your sense on how key will be the role of the U.S. jobs data? Because the markets are keenly awaiting that. And in lieu of that, what the Fed commentary on tapering is going to be like?
Well, obviously, a strong jobs data will reignite fears that a taper will happen earlier than the market currently estimates. So the estimates seem to be around sort of March time of next year. So strong jobs, I think near-term equity markets will take a little bit of a fright, in as much as obviously a taper will happen earlier. But more importantly, I think, is the fact that if the U.S. economy is doing better, this is obviously good for growth. It's good for the exporters within the Asian region, all of whom will benefit from a stronger U.S. growth environment. And so short-term, a little bit of a jitter, but when markets realize that actually you buy equities because of earnings, then the markets will start to regain their poise.
Right. Do you think 2014 could be an exciting yet a challenging year for equity investors? Because growth surely is making a comeback, but the biggest risk is that if global central banks, if they decide to change their monetary stance.
Yeah, I mean, the interesting thing is that the perception right now is that tighter money, not just taper, but officially tighter money, which we don't actually think will happen until 2015, is a bad thing for equity markets. And yet the history, time and time, highlights quite clearly that actually when rates start to go up, equity markets by and large do well. Earnings growth accelerates, it doesn't decelerate, and it's only really towards the end of the tightening cycle that you start to see a deceleration in earnings and normally a peaking of equity markets. But it has never been the case that the first signs of tightening are bad for growth, be it earnings growth or economic growth. So from that perspective, I think people are being overly, probably almost paranoid about the effect of interest rates. So for next year, there are certainly going to be periods of time where people get a little bit more nervous, taper, and as far as growth is concerned. But what's very interesting from an emerging market point of view, or even an Asian point of view, is that both emerging markets and Asia tend to be more growth biased. And the one area where there's been obviously the most concern over the course of the last couple of years is the lack of growth. And so probably a pickup in official growth numbers and a confirmation that growth is back by the actions of the Fed ought to be a good thing rather than a bad thing for Asian markets, given that the last few years have already been quite challenging as it is.
So, Marcus, what's the expectation from the Fed Beige Book minutes which are going to be released tonight, and whether or not there is going to be any taper talk for January?
Well, I mean, our overall expectation is that, we are seeing a recovery in the growth, and so we do have a growth acceleration in terms of our official forecast into next year. And so the view that we've taken is that, the most probable time is going to be March for taper, but there is also an outside chance that maybe it'll happen sooner on the back of overall stronger growth. So growth tends to be equity positive. Obviously, it's a little bit more traumatic for bond investors, but out here in Asia, equities, tend to be a bigger slice of overall investment pools than bonds, and so actually it tends to be, equity friendly, as I mentioned.
Marcus, where does India fit in the overall scheme of things? Because India surely has been a big recipient of global flows. Do you think India has an economic bottom in place and 2014 could be a year of big upturn for Indian economy?
Yeah, I mean, it's interesting. We've been underweight India this year, and obviously that's helped in terms of the portfolio returns. Our focus had really been on the current account, which for a while was getting larger and larger. It's now begun to improve, which is obviously good news, both in terms of the support that it gives to the currency. The equity investor, however, has continued to be really quite optimistic on India, and so within a GEMS context, it is actually one of the biggest overweights that investors have. So from a growth point of view, the risk is no longer so much on the current account, which is indeed improving, but it's kind of shifted a little bit on, this is a very well-held equity market, so that's something to bear in mind. And obviously, over the course of the last week, the oil price has started to move, and we all know that India is very sensitive to changes in oil. So we're underweight for the moment. The good news is valuations have corrected. This is now no longer an expensive market with valuations trading below average. But in terms of the outlook for next year, we have quite a sort of a muted return target between 6 to 8%. So it's not one of our sort of more aggressive market returns that our local analysts and heads of research have come out with.
Final question on India then. Historically, we've seen that election has been a defining trend or a defining moment for Indian markets. So in the overall scheme of things, what is the importance of Indian general elections, and are you advising your clients to a bit vary in the run-up to the elections?
I mean, the interesting thing is we always tend to kind of have a focus on elections, and we tend to forget the bigger picture that elections come and go, and that the equity markets are still here. And sort of looking at the pundits or trying to look at the polls in the last few elections, not just in India but globally, has tended to lead people astray. So what we like to do is focus on the underlying fundamentals. The fundamentals for the emerging market economies, by and large, are improving. The concern that a lot of investors had regarding India was the current account deficit. That is improving. Valuations are also often mentioned as an area of caution. Again, those valuations have corrected, given that the equity market has obviously underperformed this year. So from the perspective of the underlying economy, the valuations, we're looking at the market more favorable now than we did at the beginning of the year. And so from that perspective, that's what really counts as far as we're concerned, is the underlying fundamentals. And net at the margin, those are getting better.